afternoon, everyone. Thank you so much for joining another Barometer Readings webcast, the abridged edition, hosting today, this Thursday. Joining me, as always, is our Chief Investment Strategist, Chief Investment Officer, and President of Barometer Capital, David Burrows. On today's webcast, David will provide you a brief macro overview and also be pleased to address your questions at the tail end of the conversation. So don't be shy. You can email myself, Pamela Hastings at phastings@barometercapital.ca, or hit us up on the Q&A or the chat via Zoom. And with that, on this delightful spring afternoon, David, I turn the conversation to you. Thanks so much.
Thanks, Pamela. And thanks everybody for joining us today. Market continues to be tricky, continues to be lots of cross currents. And certainly there's a lot of opinions, some very well-known folks making their views known. Bulls and bears on both sides. Lots to digest. And I think, as always, probably the most important thing is to understand what's happening underneath the surface of the market. How is the market reacting to news? It's less about the news. We've got things to think about coming up. We've been through a lot of news flow over the last 3-4 weeks. We've gone through an earnings season. We've gone through lots of forward-looking guidance. We've gone through a bunch of inflation data. We've gone through employment data. There's a lot going on in the world stage. And of course, we got the debt ceiling coming at us next. So lots of things for investor to digest. And along the way, lots of opportunities to make their decisions as to what they want their portfolios to look like kind of as they go forward. So just quickly, as we start, always from the top down, we continue to believe we're in a structural bull market in stocks. It sure feels like this correction has been going on a long time. It's coming up on 18 months, which is not, certainly unprecedented. The recession, 1990-91, where we lost just a ton of U.S. banks in the savings and loans crisis, went on for 18 months. It was about 20% top to bottom from best to worst. At the worst point in October, we were down just about 26% in the S&P. And we're certainly off those lows, but we continue to be above a rising 200-week moving average, which we use as a lower bound for a structural bull market. Certainly, should be considered, and these things all are relevant. So continue to believe we're in a structural bull market, but let's kind of move forward. U.S. stocks relative to the rest of the world. Well, this is a change. We always talk about trying to recognize changes as they take place. We talked a little bit about this over the last few months, gaining prominence. This is a plot of the S&P 500 versus EFI, which is, of course, the rest of the world. And you can see that for many, many years since the financial crisis, the S&P has led. But over the last few months, we've seen some change taking place. We certainly have seen year-to-date global stocks do better than the S&P. And the S&P has done reasonably well, driven by the biggest stocks. But it's something I think that we want to take note of, because when it starts, it tends to go on for a while. And we put this slide up a few times, that when you got the rest of the world outperforming US for more than a year, it tended to be persistent. And so we have to kind of take that seriously. Why is that? Well, global PMIs have been pretty good. We've had 5 months of positive change in the global PMI data. Tends to be good for global equities. This comes from Ned Davis. So we all worry about what's going on in the US right now. We all worry about the Fed tightening cycle, and of course the tightening cycle around the world. But the world seems to be fairly resilient at this point. When we look at bonds, we believe that we saw a generational low in yields in 2020, and certainly yields rallied sharply off the lows of 40 basis points. They've been consolidating now for many months above the long-term moving averages, as they're slowly turning higher, which they should do if we're going into a structural higher rate environment. And when we look at the more granular, there's the TLT, which is the long end of the U.S. bond market. It has bounced since the lows in the late fall, but really there's been very little price movement higher as we've been going through this last number of months. And given the fact that people believe that we will see a significant slowdown due to the tightening cycle, you would think that maybe bonds would act better, given all the flows that have worked their way into bonds year to date. So one asset class has been a big beneficiary aside from cash. Really not much by way of progress. And when we put it under a microscope, 30-year yields have really just consolidated sideways with a rising moving average. Now, when you have a wedge pattern like this, you most often resolve to the upside. I know that would be counter to what a lot of people believe should happen if the economy slows down. But this is just the way the market is behaving. So we got to take it seriously. We do have rising moving averages. We have reversed a long-term trend. It's very possible after a period of consolidation, the long end of the bond market could continue to be sticky. Another reason we don't particularly love bonds, we're talking about the debt ceiling coming up. This 1-year credit default swaps for a number of countries. Strange to see US 1-year credit default swaps at 160 basis points, which means that people are demanding, more protection for US treasuries than they are for Mexico or Greece or Brazil, which is certainly an unusual thing. So we just think that US Treasury bonds not such an attractive asset, yield not so great as to offset. I certainly wouldn't want to own a 30-year bond right now. And so we continue to believe bonds are in a structural bear market. From a commodity perspective, it's been a nice reversal off the lows in 2020, but it's been a long drawn out consolidation through the course of the Fed tightening cycle. The only thing that I would point out is that, we have moved to a world where the moving averages are moving higher. We've gone through about the fastest, most significant tightening cycle in the last 40 years. And commodity prices have certainly moderated, but they really haven't come down very much. And so again, in these sort of wedge patterns, you would tend to come out to the upside, which we did recently. We pulled back over the last couple of weeks. Today was a very sloppy day for commodities. US dollar had a little bounce. But it does not change the picture. This is a live picture. We are not breaking down in any way. We've worked off the overbought condition that we got to last year. And I think that it's sort of biding time. Now, there's a good chance that we've through the end of the Fed tightening cycle, and we'll talk about that as we go. But if that's the case, it's very possible you see commodity prices move higher, because we know when a commodity bull market gets going from a very undervalued position, it can go on for a long time. We compare a bunch of different things to the S&P. This is the DBC, which is the broad-based commodity ETF, continues to compare favorably, reversed a long downtrend back to 2008. Oil versus the S&P reversed a long downtrend. Agriculture reversed a long downtrend. So I would say that it is testing investor patience while it's consolidating to see a resumption of the upward move. But relative to S&P, I would continue to favor commodities, given the fact that we probably have just begun a revaluation cycle. There's gold versus the S&P. And last time we got a reversal there was in 2000, 2001. And we know that you could make money both in stocks and gold over the period, but gold was a much better place to be over the next 10 years. So continue to believe that is the case. Gold versus the NASDAQ looking attractive. And, it's not for no reason. There's accumulation going on by central banks around the world. Certainly China and Russia and Iran and Brazil have been big buyers. We aren't going to guess at what their motive is, other than it's been about the biggest year of net buying by central banks as we go back a long way, and the technical price pattern for gold continues to be pretty attractive. So commodities, we believe, are something you really have to keep a close eye on, and probably commodity producers, because we know after long periods of underperformance, investment in new capacity or even maintaining capacity means that we are constrained for supply going forward. US dollar continues to bounce along the lows here. You can see it was up just a snip today, but we've got all the moving averages moving lower. We're below all the major areas of support. This would be the last line of defense, somewhat below us here. There is a short position against the US dollar. It's been weak versus the pound and the euro and the yen. We're not on our own with a bearish view on the US dollar, but if we were to break those lows, certainly would be supportive of commodity prices. So let's talk just quickly data. We're not going to spend too much time on this. We're, of course, through the earnings season At the end of the day, earnings or revenue surprises came in positive, up about 2.6% ahead of estimates. Earnings reports came in about 6.5% above estimates. Notably, things like, materials came in 17% better than estimate. Consumer discretionary came in 26% better than estimate. Utilities were the one loan group that really was a broad miss across the board. Earlier this week, we had the CPI data. CPI data was widely worried to come in hot. It didn't come in hot. It came in about as expected, but probably the most important thing, we break out the components here of CPI, and in blue are the services. There's the services component, which includes housing, and this tends to be quite sticky, and it came in a fair bit lower than expected. So that's favorable from an inflation perspective. And then we got the PPI data today. We've now had 5 months of falling PPI inflation, came in at 2.3%. And, you put it in perspective, over the last many years, we certainly had a sharp spike in producer prices, but we've seen a real decline. So the Fed is getting what they want. They're seeing CPI come down. They're seeing PPI come down. Today, in the jobs data or the unemployment claims, they came in higher than what was expected. So again, a little bit less hot from an employment standpoint. So my guess is that given the signaling the Fed made at the last meeting, they probably are done the hiking cycle. And I won't go through it again, but it tends to be once the Fed has done the hiking cycle, really only 2001-2 had further weakness in the market to go. Other cycles had the lows in. So we come at this our own way, and everybody's got their own approach. We have a belief that 70% of return comes from getting to the right neighborhood, the right asset classes, and the right sectors and themes. And that's my job as our chief strategist, help target specific parts of the market that have a tailwind. And then our bottom-up team, and at this point, Jim Skatakis is our lead portfolio manager, leading our team of analysts, James Callahan and Brian McNichol and Emmett Yoshi, look to identify securities to use to express our view. So our top-down work tries to take all of the groups that we could focus in and drill down to groups that we think have a favorable tailwind. And then using our bottom-up work, find securities that are good getting better, things that have positive fundamental characteristics in their income statement and their balance sheet that point to positive change. So good getting better, and price characteristics that would support the view that they're timely, technically, that are resilient and in clear defined uptrends. And that's where our portfolio lives. Of course, the third piece is the selling strategy. And that's a tough one. We need to have rules around how we exit. We need to make sure little mistakes don't turn into big ones. So the one thing I'd say is that this type of market does wind up being tricky when you're going through a transition, as many of these asset classes have been. There's a lot of pushing and pulling, a lot of conflict. For a few weeks, the bulls exert their force. For a few weeks, the bears exert their force. And this wrestling match goes on over a period of months until ultimately things resolve one way or the other. And in that period, I will say we do wind up getting stopped out of some positions. And that's our job, to make sure that things don't go really wrong. Gladly, over the last number of weeks, we did reduce some bank weight, and that was probably a good thing. We probably got shaken out of a little bit of energy weight earlier in the year, but the net of it is we want to make sure that the portfolio is relevant as we start to lift and as we see strength in the market. So we determine the top-down targeting or the tactical targeting in the portfolio using breadth models. And my focus is running a set of models that track the progression of breadth over time. We know late in a cycle, as in that we get to a point where almost nothing's working, the strongest stocks turn up first, and then over time, breadth expands. And over time, in a healthy market, more and more stocks should participate. When there's a concern, the things closest to the concern generally sell off first, while the leaders continue on. But if the breadth breaks down enough, it can impact a broader list of securities. So we look through this lens all the time. Ideally, we want to find groups that have gone to be out of favor and are unloved, but where we see net improvement underneath the surface. When we see deterioration in breadth in a group that has been very strong, we take notice of it, because it may be that the leaders are carrying the day and the weaklings aren't. So it's a way to look at the world. Now, I raise that because as we sit right now, we have seen over the last few weeks some deterioration in breadth in the NYSE. We've seen some deterioration in breadth in the NASDAQ, yet the index continues to look pretty strong. Now, we spent some time over the last number of webcasts talking about the fact that global breadth continues to improve. In fact, all the short-term and long-term indicators that we use continue to show improving breadth in global equities. There are some strong parts of the US market, and there's some weak parts. The percent of stocks trading above the 50-day moving average remains positive, but we see a lot of our shorter-term indicators showing us some caution. If we looked at it through the lens of the S&P has been going through a bottoming process. We had a low in June, a lower low in October, which marked the most recent low, and then a series of higher lows since then. And we're sitting not too far from the highs, which makes us feel like things should feel good. But I don't think very many people feel good. If we look at the equally weighted S&P 500, take out the impact of market cap weightings, take out the impact of Apple and Microsoft being 14% of the S&P, and give every stock a single vote, you can see that the equally weighted index over the last few weeks has been getting worse. So that's something that we're keeping an eye on. What it means is that we're not adding new positions. We got a lot of great positions in the portfolios. We've been stopped out of a few, but I am taking note of this. And it doesn't mean that things can't improve, but it does mean that at the margin, the average stock is doing worse, which is probably why most people don't feel like they've been doing as well as the index itself. Now, I mentioned Apple and Microsoft are 14% of the S&P. And as the market made a turn at year end, a lot of people who have a lot of confidence in large cap tech due to the strength over the last several years came charging back into this group. And I want to be a little bit cautious. If you look at the year-to-date performance of the market cap weighted ETF, S&P, the S&P 500 versus the equally weighted, only one other year since 1990 had such a strong start or such a differential in the S&P versus the equally weighted S&P, and that was in 2020. If you looked at what happened for the rest of the year, 2020 or 1997, it is interesting. Both cases, the market was up over 20% from the end of April to the end of the year, and the market broadened from there. And I'd like to see that take place, but at this point, it's a very concentrated market. So we talked about the fact that we do have tech, but our tech weight really is focused in those very, very large cap technology stocks. But we don't necessarily think that that's where the longer term returns are going to come from, given the outperformance over the last number of years. So let's talk a little bit about leadership. From a breadth perspective, groups have moved a little to the left, meaning that breadth has narrowed in general. The average sector has about 37% of stocks in uptrends. It means there's some great performing stocks and a lot of weaker ones. You'll note at the far left, banks and regional banks have about the weakest breadth. And at the other end of the spectrum, interesting, you've got home builders, which we've spent some time talking about, machinery stocks in the industrials, precious metals acting quite well. Other areas of consumer, leisure, and restaurants. We've got some strength in some of the other materials, sort of in the middle of the pack, but it's a mixed bag. So let's just talk about that a little bit. Now, the topic continues to be financials and continues to be concern around regional banks. This is the KRE ETF from the beginning of the bear market, 2022. You can see it's come down a long way, 76 to 36. And this was the move down and the initial leg of the concerns around SIVB and and Signature Bancorp. We've moved down again over the last week or so. We've highlighted that this is a very mixed bag. So the worst performing of the regional banks are in the headlines. And then there's a whole group that are down in sympathy, but probably have a different business model and a different risk profile. I want to keep in mind that this does not look at this point anything like 2008-9. In 2008-9, you had a couple of large banks that went bankrupt, but look at all the banks that disappeared. When we look at the situation today, we have three very specific cases of where, due to a business model not well structured for the environment that we're in, very focused in specific industries or geographic regions, you had runs on the bank and difficulty from the business model. I would say at this point, this looked very different than the situation in 2008-9, but we all have memory of the financial crisis. We want to make sure we don't get caught. I'm not saying that we don't have caution. I'm just saying it looks different. The number of banks in the US has been declining steadily from 17,000 banks in 1984 to 4,800 banks today, and that's happened for two reasons. One, banks disappeared, or they were accumulated or gobbled up by large banks. So this is a large banks ETF, KBE, relative to the regional banks ETF, KRE. Look at how much better the performance has been in the big banks. If we compare the banks we're focused in, JP Morgan versus the big banks ETF, the stronger of the two, JP Morgan and Royal have been giant winners relative to the rest of the banks. So it's always about finding good getting better. And in the case of banking, the big are getting bigger. The big are winning the deposits and the big are winning the fight. We're focused on the ones that are good getting better, not broken getting fixed, which can be a problematic strategy. So I just say it's really important to understand the group, and we have less exposure to banks in general, but certainly we want to be in the highest quality and we want to use our stops. Now, we talked about in our financials weight, the larger part of our financials weight has been insurance. So this is comparing the KIE insurance ETF, which is made up largely of property and casualty companies like Fairfax, that are be a large holding for us, versus the large banks. So KIE versus KBE. And again, insurance well outperforming even the large US banks. So again, we have to high grade. We have to understand what's happening internally. We want to focus in the areas of outperformance, because at some point, this banking problem will run its course and the financials will rally and the strong will survive. Let's talk a little bit about tech. Tech has had strong relative strength so far in the year, but to be clear, it's in the largest of the large cap name: Microsoft, Apple, Oracle, NVIDIA, and so on. And we've talked a little bit about some of the names that we own and the fact that a very significant portion of the return in the S&P this year has come from a very small number of stocks. Companies like Apple, Microsoft, NVIDIA, they continue to perform well. But I will say I do have concern because breadth in the NASDAQ is weakening. So remember, we talked about breadth a few moments ago, latent in advance. The returns will come from a small number of companies, and under the surface, lots will be performing poorly. So we do have a significant technology weight. It is an underweight portion of our portfolio. I'm not saying these aren't great companies and will stay there as long as they perform well, but they're on a tight leash and we'll be willing to step aside should we need to, because as we talked about last week, historically, in the longer cycles, you get to a point where the largest companies in the world are tech, and then maybe over the next 10 years, it winds up being an oil company. Tech, oil, tech, oil. And we think that when we look at what's going on under the surface, things favor the more cyclical companies longer term than technology. Now, during this bear market last year, as bond prices fell in teal colored, so too did technology stocks. Because as rates rose and bond prices fell, we have to discount the future earnings for technology companies, where we sometimes pay a very high multiple. back to the present using a higher discount rate, which means they're worth less in the present time. Since the beginning of the year, you've seen technology rally sharply, but the bonds are not. So there is a disconnect. And when you get a broad disassociation like we've seen over the last few months, it tends ultimately to close. Now, maybe it will be that bonds will rally, but I can't say that they're set up looking like they're going to at this point. So on the other hand, it could be that tech reverts lower or simply underperforms. Something to keep in mind. When I look at the long-term technical setups, however, I would favor something like this, Canadian Natural Resources, that went through a 13-year bear market, came out and has consolidated over the last few months while the Fed's been raising rates. To me, we get out the top end of this range, we probably go a whole lot higher. And the same picture for something like Teck Resources. Again, it feels like Tech's pulled back a lot in the last 2 weeks. These are monthly bars. This is a very attractive looking price pattern. So I understand there's concern about the impact of a slowing economy on things like energy or things like copper, but the technical setup supports having a weight and the risk reward being much better because these groups are underowned, while certainly tech is highly concentrated in institutional and individual portfolios. Let's move beyond. Continues to be that industrials look favorable. They're trading above the long-term moving averages. Certainly, they've been consolidating. Defense stocks, very, very similar. Companies in the power grid equipment, machinery look attractive. We have the GRID ETF, which is largely infrastructure equipment. And we see that manufacturing jobs, counter to some of the other groups, continue to grow. When we look at the home building, again, continues to defy expectations. The stock's trading as of yesterday at a 52-week high, today off just a little bit, but certainly acting well. Things like Pulte performing well. Over the last number of weeks, some of the healthcare names have been acting well. Jim Skatakis, very effective in getting us into these names. Eli Lilly, which of course is the company that has Ozempic, have been used largely for diabetes at this point, but we know where it's going. It's going to wind up focused on weight loss, and there's an enormous market there. And Merck also trading near 52-week highs. So we go forward. We have a weight in technology at about 15%. Our weight in financials is less than it was. It was about 15%. Probably 10% of that would be insurance companies. 5% would be banks. We got an overweight in industrials. We got an overweight energy. We got an overweight materials. We have a small short-term bond component, which is largely Government of Canada, sort of one-year bonds, and those would largely be in our balance mandates. Our position in healthcare has grown a little bit, and our cash position is about 5%, which gives us flexibility. We're not adding new positions currently until we see those breadth models turn higher. We'd like to see the market breadth models turn higher, short and long, and then we'll watch for which groups start to show performance and start to show breadth progression before we start adding. At the other end of the spectrum, long duration assets, things that act like bonds, real estate and utilities and consumer staples continue to be very small parts of our portfolio. We just don't see the risk reward given the fact that multiples are high. Now, just quickly, I want to revisit global. This is the FEZ, which is the Spider Eurostoxx 50 ETF. You can see relative strength marching higher steadily since last September. Mexico, again, global index. It's got basic materials and energy in there. Made a 52-week high as of yesterday. Made a new relative strength high. Japan, a market that has underperformed since 1991, but has been moving higher smartly in higher highs and higher lows and rising relative strength going back to the middle of last year. So global continues to look good. I know we're concerned about an event. Volatility does not tell us that this is on the doorstep. Now, this can change, but volatility sitting well below the recent highs over the last year and way below the highs from 2020 We watch for signs of it reversing. We don't see it at this point. So why is the market holding up against all this negative news? I think there's a lot built in. We showed this a couple of weeks ago. When a group of investors at JP Morgan Private Wealth were surveyed, 95% of their investors expect the market to be lower at year end than where we are now. If they believe that, they've been repositioning to expect it. We know that big money managers, the difference between bulls and bears, shows a really bearish sentiment. We know that the flow of funds has been into cash. I showed this a few weeks ago at 5.1 trillion in money market funds, now closer to 5.4 trillion. We know margin debt has collapsed. In other words, speculators are not in the market on leverage. We know that many bearish managers are loaded up on S&P 500 mini futures short bets, using S&P futures to hedge their portfolios. And we know that hedge funds, long short managers, are far more short than they have been in a long time. So I keep putting this up because I think it's relevant. Market made a low in October of last year. The end of September, it was down 25.9%. When the market was down over a 9-month period, and you looked out sharply, you looked out over the next period of time, there was a couple of occasions where 6 months out, the market was negative. We're beyond 6 months at this point. Now we got to look at where we're going to be 6 months from now. And you can see that 1 year, 3 years, and 5 years out, market was considerably higher. Doesn't stop there. We look at years where the S&P was up more than 7% in the first quarter, back to 1950. Full year returns averaged 23%. Pretty positive double-digit returns going forward. We looked at markets that hadn't made a new low 6 months after the previous low. In only one case, 2001, the market wound up negative a year later. And this is a more recent data point. When the market turned eventually up over the previous 12 months, which we did in April, we broke a streak of 12 consecutive months with negative 12-month rolling price return. We know that going forward, and this is back to 1940, going forward, 12 months out, markets were higher. But volatility is a cost of investing. And I continue to say that human time feels a lot longer than market time. Corrections are natural. About every 2.7 years, you get a bear market. Every 1.5 years, you get a 15% correction. In every case, there's a reason why the market corrects. We've been living through this since the beginning of 2022. At some point, we start to lift out of this. We made the low in October. It's been a long time since then, more than 6 months. And we know that what comes after bear markets are long runs, and they start when the news is bad. So I just hope we all have some patience. We're trying not to do too much. We're sitting on our hands. Where we need to use our stops, we use them. But we're not adding new positions. We'll wait and see our models turn back higher. And in the meantime, we wait. If things get worse, we'll continue to use our stops. We'll continue to raise cash. But my guess is a year from now, we're all going to feel a whole lot better. So with that, Pamela, if there's any questions, certainly happy to answer them.
Thanks so much, David. Great presentation as always. We have a few questions here. Hanson wants to know your thoughts on NVEI as well as Stantec STN.
Okay, so I'm not going to make a comment on Neve because I haven't spent a lot of time looking at it over the last little while. But certainly Stantec, we think, looks really attractive. Now, just quickly, see if I can find it here. You know, these things are going to have pullbacks. Certainly, the whole resource space was weak today. I'm going to guess that's probably why. I don't think that there was probably a specific piece of news, but I can certainly find out. We're going to have these short, sharp pullbacks. I'll tell you what, if you shoot me an email, I'll pull together some information for you and we'll answer the question for you directly.
Thanks so much, David. The next question is your thoughts on value investing versus growth investing, especially given the environment.
Yeah, look, I think ultimately value is what leads in the next cycle. As we sit right now, very large cap growth is outperforming. And I think that's, this is a place that people feel most confident looking back over the last number of years. They did very well. We are big Apple shareholders. I do get concerned. Apple is trading at 30 times earnings with a 0% growth rate. We're fair ways above the moving averages, but I'm not going to argue. It's acting really well, and it's a great company. Okay, so I do think that when we look at things through a longer term lens, when tech has outperformed for a really long time and then goes through a period where there are changes and a deceleration in growth rates and a rising interest rate, which means you have to discount future earnings, there's a headwind to see it do the same thing again. So I think that longer term, we probably have a better opportunity in more value-driven companies. Groups like energy and materials and industrials are inexpensive relative to history. They're under-owned. They're relatively small parts of the index. Companies like CNQ have paid down just an enormous amount of debt. They're generating gobs of cash. They pay a great dividend to start with. We're likely to see very strong dividend growth going forward. And all we need to see is a little bit of multiple expansion. Oil prices have been sold off. Oil has been sold off by hedge funds because they see it as a way to sell short against economic growth. My guess is that supply demand will support higher prices as we go along. And I think that long-term picture, for a CNQ looks a whole lot more attractive than the super large cap tech. Now, in the very near term, for sure, Microsoft is attractive because of the themes in AI, and we're there. NVIDIA looks attractive for the themes in AI, and we're there. Apple will likely participate there, and they've got lots of things going on. I'm just saying we don't have to be so concentrated in just a few names. The risk reward is probably better in other places for longer term returns.
Thanks so much, David. Well, that concludes the questions we've received. And Hanson just responded. He said both NVEI and Stantec had earnings today, so he's going to send out an email to you, Dave. So on that note, thank you so much as always. And I will leave you with the final word.
Yeah, look, here we are in May. We've got a debt ceiling in front of us. The market's going to chop around. And what we're going to watch for is we're going to watch for an up day with big volume. And we're going to look for a really good advanced decline line where the number of advancers outnumbers the decliners by 10 to 1. And then we would want to see another day within the next 7 days where that happens again, or a follow-through day. Until then, we're just churning through news. We're going to trade our portfolios position by position, and we'll watch for big thematic change, which we're just not seeing at this point. So stay tuned. Everybody understand that what we're going through is perfectly normal. And at this point, there should be lots of people concerned about things going on in the world. We've had 18 months of correction. The market's been discounting. So with that, we look forward to doing these again on Tuesday next week. I'm sorry I was traveling this week and I was traveling the week before out seeing clients and doing meetings. But we'll do Tuesday afternoons at 4 p.m. all the way through the summer. And if you got questions, shoot them in. If you want to talk about something offline, don't hesitate to give us a call or send us an email and we'll set up a time. We had some great meetings in Winnipeg yesterday with a great group of guys and 2 other large family offices that we do some business with. We were in Calgary. We're going to go back, I think, in June, and we'll be in Vancouver and Kelowna in June as well. So maybe we can see some folks in person. Pam, thanks very much for hosting, and we'll see everybody again next week.